Welcome to week 2 of venture development. A few quick reminders. You got a quiz this week. It's due Sunday. By the end of the day, it's over chapter 9 of our course textbook, and it's worth 50 points. And again, there's no late submissions. Simply the course is going to move really fast, and I don't want students to get behind. So try to stay on top of the quizzes. You have an assignment coming up September 17th, the project number 1. So I want you to go into the project folder and review those requirements and even start working on it if you want so that you're ahead of the ball. Chapter 9 in NEC is all about revenue. So here's a question. What's the difference between a for-profit and a non-profit in terms of revenue? It's kind of a trick question. They both need revenue. So we think of a nonprofit as fulfilling a social mission and it's not to make money, et cetera, et cetera, et cetera. It's not profit driven. It may not have a profit because it's tax exempt, but it certainly has employees. It may have a physical location that a lease payment must be made. Utilities for power and water must be paid. So whether a business is profit or nonprofit, they all need revenue. They just have different types of revenue. Revenue is simply the income from the sales of goods or services. Now, in a nonprofit might sell something and then use those proceeds, the profit, for a charitable purpose, or it might rely on generosity or donations or grants for revenue. What is a revenue model? It's simply how a company identifies how they will make or earn income. When we start looking at revenue models, you can't do this in a vacuum. First question you ask is, how much are my customers willing to pay? How many do I need? How much revenue can I generate through sales? And if I have more than one revenue stream, how much does each revenue stream contribute to the bottom line? I will say this, I encourage you, if you're building an entity or a startup, to try to have at least 3 revenue streams for your startup venture. Different types of revenue models. Again, you can combine more than one revenue model within a single venture. The most common would be unit sales. Unit sales would be, for example, retail businesses, and you're selling based on volume. Now, a very good example would be the razor and blade model. If you buy a razor, they're relatively low cost. That's one unit. But what they're really banking on is that you coming back and buying more disposable blades monthly, and that's where the unit sales really begin to ramp up. Advertising revenue model. So you look at Google AdWords, they generate money cost per click. And so we're looking at, well, if you have a e-commerce website and you're doing unit sales, you're selling a product, you might also generate a second stream of income via advertising revenue. Data. We all know that Facebook sells our data. We all know that Google collects data, sells it. Amazon does the same thing. And so again, if you're doing anything in e-commerce, is there a way that you can lawfully and fairly and securely collect data and leverage that for a source of revenue? Now, the intermediation revenue model here, think about if I were to go out and buy a house tomorrow, commonly I'll use a real estate agent or broker. We have the seller, the buyer, and we have an intermediary who is the real estate agent or broker. Licensing revenue model. Often I'll meet with students who have business ideas and the cost of manufacturing, selling is prohibitive. However, their underlying product or idea is attractive. So oftentimes what we will do is we will go to an existing corporation who has the resources to take the product to market, and we'll say to them, hey, what if I sell to you a license, meaning for the next 5 years you have exclusive rights to manufacture and sell this product. I still own the underlying product, but I'm given, the company the exclusive right to develop and sell for a period of time. And for that, I am paid well. The franchising model, Taco Bell, Anytime Fitness, Subway. What you do if you want to open up a Taco Bell or a Subway, let's use Taco Bell, you write a check up front and you pay a licensing fee, a franchise fee, where they're going to say to you, okay, we're going to allow you to open up a franchise, Taco Bell franchise in Mount Pleasant. You're going to pay X amount up front, and then we're going to take a percentage of your profits. Downside is, it's also an upside. Taco Bell is doing all the advertising for you because you're selling off their brand, but at the same time, you must comply with all of Taco Bell's rules in terms of what your store looks like, how it operates, etc. Subscription. I do this on my phone. I have various apps that I subscribe to, and so that's a great revenue model as well. Professional, historically you've got consultants charged by the hour, you've got accountants, lawyers, but then today we've got something new thanks to the gig economy, freelancers. Freelancers are charging by the job, and so that would be a professional revenue model. The utility and usage, pay as you go, pay as you use. So my consumer's bill, my utility bill, is based on how much energy I consume. The freemium, I use Adobe Photoshop, Express, almost on a daily basis. It's free. They keep trying to get me to upgrade, etc., and maybe someday I will, but for right now, I don't need it. Same thing with SurveyMonkey. You can do free surveys, but once you reach a certain threshold, you'll have to subscribe. Revenue and cost drivers. Let's look at revenue drivers. We've got 4. We've got customers. How frequent are the customers? What is the selling process? And then what is the price? So these 4 factors drive revenue. How do we identify for my startup business or your startup business the revenue drivers? You can't do it sitting behind a computer screen. You need to get out and talk to your customers. You need to get out of the building. You need to go test your assumptions. You think that customers are going to buy this product 6 times per year. Well, that's an assumption. How do we test it? We actually interview our customers. Cost drivers. There's 2 types. Cost of goods sold, which is COGS, and operating expenses. Let's look at COGS first. COGS is the direct cost of producing a raw product. Let's say I open up a t-shirt store. I need t-shirts to print on. And so the cost of the raw blank t-shirt, that's a cost. I've got the materials, the design, the manufacturing, the ink, and the packaging if I'm selling. Now let's look at operating expenses, the cost of running a business. And here's just the common operating expenses. If I've got a brick and mortar location, let's say a coffee shop, I've got rent, I've got utilities, I've got insurance, might have transportation, definitely have administration. I'm going to have people run it. I'm going to pay taxes. I've got marketing, advertising, might have some legal fees in setting up my business, definitely have salaries for people that work for me, office supplies, going to have to pay somebody to keep the books, and then I've got benefits if I offer them to my employees. Income statement. What is an income statement? Typically, they're monthly, and each month we'll look at, okay, we had X number of dollars come in, revenue, we had expenses, and what is our net income? So revenue less expenses equals net income. So let's break it down a little more. Gross, we have revenue here of $200,000. Let's say we sold $200,000 worth of T-shirts. The T-shirts themselves cost us $100,000. That's our COGS. So that gives us a gross profit of $100,000. Then we have these different expenses: sales, marketing, research and development, depreciation. Subtract those, gives us an operating profit of $41,000. Then we have some interest on a loan that we use to help start the business. We've got some taxes. So then our net income is here, $31,270. This is actually an excellent template for you to keep in mind if you're going to be doing the New Venture Challenge this year at Central Michigan University. How about pricing our product? We can do competition-led pricing. What's the market? We're going to go above, below, or compete the same price, but try to sell on quality. Customer-led pricing. Do we go out and research and get feedback from the customers on what our price should be for our product or service? Or are we going to tease the market, throw our product out there at a loss to bring them in and upsell them on something else? We have an introductory offer. We have skimming. And then we have the psychological pricing. And this is where we see that something is, 40% off. And we jump at it because, wow, it's 40% off. 40% off of what? When we are rational and we think about it, from a non-emotional perspective, we look at net price. If it's $20, it's $20. But if they inflate the cost to $35, then reduce it, we're still going to be paying $20. But they work, don't they? The sales work. So that's an example of psychological selling. Whether or not the price is fair as determined by the customer. Then we have bundled pricing, where we bring different products together and under the assumption that when I buy a package or a bundle, it's less expensive than buying each of the bundled items separately. How do we calculate the price for a product or service? We can do cost-led. We figure out all the cost and expenses, and then let's say we want a 10% profit margin. Total up your cost, then add 10%, that's your selling price. What if we want target return pricing? Here we look at how much we've invested into the business and how much we need to get or want in return for our investment. So maybe we determine we need a 20% margin to recoup our investment. Value-based pricing. And again, this goes back to how it benefits the customer. Week 2, not a lot to do. Just focus on Chapter 9 and make sure you get the quiz done by Sunday, September 10th at 11:59 p.m. and you'll be all set. Please reach out to me via email. If you have any questions, I'll be happy to help.